Today, we're going to break down a really fascinating investment strategy. It's all about finding profit in patterns, not, trying to predict the future. It's called pairs trading, and honestly, it kind of flips what we think we know about the market right on its head.
I mean, just let that sink in for a second. A strategy that's totally indifferent to all the chaos. The bull runs, the bear markets, all of it? It almost sounds too good to be true, right? But the framework we're about to explore is designed to do exactly that.
And that's really the core promise. The goal here isn't some massive lottery ticket win overnight. Instead, it's about building a method for, sustainable growth that can work whether the economic forecast is sunny or, a total downpour. So how on earth is it done?
Well, the very first step, it's all about finding a match. We're basically going on a hunt for what you could call a financial twin. Two totally separate assets that, for whatever reason, have a long history of moving in near-perfect harmony.
The foundation of this whole thing is actually pretty simple. You just have to identify two assets, could be stocks, currencies, whatever, that have a track record of moving in sync, almost like they're tied together by some invisible string.
The absolute classic example that makes this crystal clear is Pepsi versus Coca-Cola. Think about it. They sell similar stuff. To the same people, they face the same industry trends. So it just makes sense that when Coke's stock goes up, Pepsi's tends to follow along, and vice versa.
And this idea, it applies all over the place. In crypto, you've got Bitcoin and Ethereum. In the car world, Ford and GM. In energy, you have giants like Exxon and Chevron. They might be fierce rivals in the business world, but in the market, they often move like dance partners.
Now, this tendency for two things to move together, it has a technical name, high correlation. So finding a pair that dances to the same beat is job number one. Once you've locked that in, you're ready for the next phase.
But here's the twist. The real trading opportunity isn't when the pair is moving together like they're supposed to. Nope, it's when they suddenly stop. This is where the strategy actually kicks in, that moment when the twins diverge.
Exactly. This is the trigger you're waiting for. For some reason, maybe some company news or just a market overreaction, one twin zigs while the other one zags. That invisible string connecting them suddenly seems to stretch, and that is the opportunity.
And here's the playbook. It's 3 simple steps. First, you spot that divergence. Second, you bet against the one that's doing surprisingly well. That's called taking a short position. And third, at the exact same time, you bet on the one that's lagging behind, which is a long position. You're basically placing a single bet that the gap between them is going to close.
And that really gets to the core of it. You're not betting on the whole market. You're not even betting if a company is good or bad. You're making one super specific bet that the historical relationship between these two assets is going to snap right back into place. And this expected reunion, this snapping back of the rubber band, well, it has a name. It's called convergence. The entire potential profit from this trade hinges on this one assumption, that the twins will, eventually, start moving together again.
Okay, so we've got the what and the how, but what makes this so appealing compared to just, buying a stock you like? Well, that brings us to the most powerful feature of this whole strategy, the safety net.
The key phrase here is market neutral. It means you've designed a trade that is, at least in theory, insulated from all the crazy swings of the broader market. You're kind of creating a little bubble for your bet, away from all the general noise.
To really get how this works, let's just do a quick recap of these two positions. A long position is what most people think of as investing. You buy something and you hope its price goes up. Simple. A short position is the total opposite. You're betting that its price is going to go down. And in a pairs trade, you're doing both of these at the exact same time.
This really is the million-dollar question, isn't it? If you own one stock but you're betting against another, what happens if everything starts to tank? How could that possibly create a safety net?
Okay, this table lays it out perfectly. With a traditional investment, if the market crashes, your stock probably plummets and you're looking at a big loss. But look at the pairs trade. Yeah, your long stock, the one you bought, it loses value. But, and this is the key, your short position, the one you bet against, it actually gains value as that stock also falls. The profit from your short helps cancel out or hedge the loss from your long. So one side of your trade becomes a kind of insurance policy for the other side. This hedging is what aims to neutralize the impact of what the overall market is doing. Your success or failure isn't tied to whether the Dow goes up or down anymore. It's tied only to whether the relationship between your two chosen stocks gets back to normal.
Of course, no strategy is risk-free.
The success of this whole thing hangs on one critical assumption, that the twins will eventually reunite. But that brings up the final and most important question. What if they don't? What if the divergence isn't just temporary, but it's a permanent split? If that happens, who wins? The answer is nobody. And that, right there, is the central risk you take with every single Paris trade.